is Alan is going to give a presentation of about a half-hour length on the topic. Then we're going to break up, depending on how many people are here at that point, into maybe 3 groups or something like that, of not more than about 8 people each. And we're going to discuss a set of questions. And we're going to have sort of group facilitators, one of whom is Emily right there. And we'll work that out. We'll just divide us up. But one of the beauties of this place, by the way, and I would like to thank Roberto Ramos, one of the owners, who I don't see yet, and his wife, Yane. Yane, would you like to take a bow? They're our hosts tonight. And we have to make sure that before we go tonight, make sure you buy a drink or some tapas or something. You don't have to, but it'll make them feel more happier about having been generous enough to let us use their beautiful space. So having said that, we'll start with Alan, and then after that we'll break up into small groups, and then we'll come back together for general discussion. So Alan, the floor is yours.
Thank you. You better do it now. You may not want to at the end. So, I thought what I'd use this first half hour to start with is to give a very brief presentation about what I think the issues between the economy and jobs are. And then hopefully there'll still be more time in the first half hour that I could take questions from you, because I think it'll be more interesting if we have a lot of give and take. So let me just review how we got to where we are right now. You remember this all started with the housing crisis, the bubble. That bubble sort of burst. Housing prices started falling in late 2006. By 2007, since houses weren't being constructed in the same numbers as before, construction workers were being laid off. And by December of 2007, as we look back on it now, the authorities have decided that that's when the recession started, December of 2007. But it was a mild one up until that point, because it was mostly concentrated in housing. And so the unemployment rate was going up a little, but not a whole lot. And we started from a pretty low level, so things weren't all that bad, until the fall of 2008. And that's when Fannie and Freddie, the semi-public, semi-private housing guarantee corporations had to be rescued by the government. And then by the middle of September 15th, Lehman Brothers failed, and then all hell broke loose, because we went into the financial crash, which consisted of financial corporations being too afraid to lend to each other. So one bank, because it was afraid maybe that the other bank that wanted to borrow from it might be in trouble because it had all of these assets tied up in mortgage-related assets, was afraid to lend for fear they'd never get paid back. And I use the term bank loosely here. Part of our problem was that we've got banks, old-style banks, that take deposits and lend money out at interest and are guaranteed by the Federal Deposit Insurance Corporation, etc. And then there are other institutions that are not officially deposit-taking banks, but that act like banks. They borrow short-term and they lend long-term. And those were the institutions mostly that failed. The Lehman Brothers, or that got into big trouble, the Bear Stearns and so on. Right? So by September 15th of 2008, we were in deep trouble. And you may remember, since you're all good Democrats, that was in the midst of the election. And I think it was about then what was his name, McCain, said that this was so serious he was going to skip a debate, remember, and go to Washington to solve this problem. And so Obama called us bluff, and they had that meeting, and McCain didn't have a thing to say, and Obama had a whole list of things he thought the government ought to do to solve the crisis, and I think the election was won at that meeting, probably, right, at least in most people's minds. But at any rate, when the financial crash happened, then that made the rest of the economy all that much worse, because now banks are, one of the labels that's been given to this recession is that it's a balance sheet recession. Now, a balance sheet has assets and liabilities, all right, on one side and the other side. If mortgage-related assets, bonds or other kind of securities that are based on essentially mortgages are going south because people aren't able to make their payments, etc., then the assets that those banks and shadow banks hold are declining in value, and all of a sudden they're in danger of being insolvent. Their assets are worth less than their liabilities. Under those conditions, what do but hoard whatever assets and especially cash that you have for fear that you're going to get in even worse trouble, right? But the last thing you want to do is take on more lending, and especially lending to other institutions that you're afraid may not pay you back. And so the whole financial system seized up, and that's how it spread to the rest of the economy. So banks were unwilling to lend to companies that hired workers. They were maybe unable to get enough money to maintain their inventory or to even make salaries, make payroll. And the upshot was that what started as a housing bust spread to the financial sector and then spread to the rest of the economy. And the upshot was that with everyone being afraid to spend, everyone had a balance sheet problem. If your house was your major asset and housing prices were plummeting, then your balance sheet was in trouble. You were in danger of being insolvent or bankrupt. If you were a bank, obviously you were in that kind of situation. And the danger was then it was spreading to corporations that make goods and services, because they were, again, afraid that no one was going to buy their products. When the crash happened, how do we interpret that? I've spent my life studying economics, but even I was unsure what was going to happen next. And I think most people had the feeling, we don't know what's happening, but we know it can't be good. And therefore, let's hunker down, let's save, let's not get ourselves into any more debt problems, let's start saving more, just in case one of us gets laid off, etc. And what happened was saving soared, but the upshot, the flip side of that, is that spending plummeted. And spending is what drives the economy. And so when households were afraid to maintain the level of spending because maybe they had been borrowing against home equity loans, against the rising value of their houses, and now all of a sudden their housing value was plunging, but the debt still remained, they're in no position to maintain their spending, let alone increase it. Firms worried that they couldn't get loans from banks or shadow banks